Hello, fellow traders. 'Tis I, the Rumpled One. It is Tuesday, February the 13th, the year 2019. Let's talk trading. How to trade like a pro. Planning like a pro. One of the old trading, what do you call it? Rules is plan the trade and then trade the plan. I'm sure if you've been around trading for a few months or a few years or decades, you've heard that most likely at least once. Well, there's some truth to it. You definitely want to plan your trade. Now, how do you do that? Right? Well, first off, you plan your risk, your money, how much you're willing to lose. You see this every day, right? So I don't have to beat this dead horse too much. The fact is, it's not a dead horse. This is a live horse. You got to make sure you have this in place on every trade. But then what you do is you look at the chart, okay? And you decide what kind of trade you want. Now, you can decide to trade based on what price does at a certain level. That's one way of planning a trade. Another way of planning a trade is when indicators do something, such as, a couple of squiggly lines cross, or a squiggly line hits 99 or 1%, somewhere down at the bottom. So those are a couple of ways that you plan your trade. So what you do is maybe you draw some horizontal lines, or you have these indicators on your chart, and basically what you have to do is act like a trained monkey, meaning when those indicators say pull the trigger, you pull the trigger, just like a trained monkey. When price does something at a horizontal line, you execute the trade. Once again, you're a trained monkey. So we know if price enters the upper wick zone here from the previous week's candle, we know price is probably going to exit. So you see right here at 125.40, price came back down. So if you probably look at an H1 chart here, you see what happened here at that 125.40. It came down, then it started going, so you could scratch that trade. Came back in the wick zone, and it came down. You could have taken some money in a couple of different areas. And then one more time, price went up and it came down. Now, in this case, price was green, but it didn't make a new high, so it was coming down. And right now, you could have made a lot of pips. Now, we can call that a hairy hindsight trade. I don't mind. That would be fair. But that's what we look for. Now, once again, you see here price came across that yearly open and it fell back down. Once again, it failed to make a new high. It was going down. Right now, you could be up 31 pips. You see, I've been telling you about this trade all year. I wanted to start the year off and give you something else to look at. The yearly open, it's so simple. It's just like the other opens. And you can see right here on this chart how we crossed above and crossed below the first day of the year's open. Now, we come back yesterday. If you remember, we had touched the high the first day of the week. But you see later in the day it broke out. That was a very nice ride right there. Once again, having these levels, we know these levels don't change. So all we have to do is wait, and then when it when it happens, we take the trade. Now, yesterday, some people say that's a false breakout. Okay, it went up, it started coming back down. You scratched a trade. You could look here and see it came back through that wick. What happens? We know we can trade the wick zone on entry, and we can use the wick zone, the price action, to exit our trades. Now, you don't have a crystal ball, but you just put the odds in your favor. Okay, or you let statistics, you work the statistics. I'm sorry, there are no odds in trading. That's just an expression, but technically there are no odds in trading. I've talked about that in other videos. But you can see here, just using simple horizontal lines, the first day of the year, first day of the month, first day of the week. And we can trade those levels profitably. Of course, disclaimer, your results may be different. This is for educational purposes only. Once again, the open of day one. So you can see we are above the open of the month. And you can see here, first day of the year, high-low, first day of February, high-low. We're still within those parameters. Now, yesterday, I showed you price was inside the inside bar on the daily that occurred 12 days ago. Okay, you can see here 12 days ago, 12 days ago, and it exploded out once again, producing a profit. So you can see there's many different levels that you can use, or you can use them all. In fact, somebody asked me, well, which do you trade? I go, well, I kind of trade them all. I look at the charts. You see, and I show you these charts every day. And if price is getting ready to break one of those levels, I might, for example, if I'm looking at this chart on a daily and say, hey, you know what? There's a level here. I might drop down to the H1 because you guys know how much I like that trade with the H1 candle color. Because one, I trade with the candle color. Two, I look at its range. So you see right here, it was green at the line with the H1, and then came back here, barely touched the line. And so depending on, actually, that's the weekly inside bar. Here's the daily inside bar. You see, it's interesting. It broke it, came back, touched the daily inside bar. Here it broke the weekly, came back and touched the weekly inside bar. So you see how price will come back. And knowing that, then you can take your trade and act accordingly. So you see here, it broke it, came back through. What do? You take a few pips off the table. Comes back here and touches it. You say, okay, let's take the chance that you see it turned green, right? So you go ahead, take that trade. So sometimes there's rules you follow to the T. Sometimes you bend the rules, okay? But you have to do that based on what you see. And my number one rule of thumb is trade what you see. It's that simple. And so you can see here the weekly inside bar high, the daily inside bar high, right there. And you see this, you might have a setup to trade that again. So we'll put the daily back on the screen so we can see it. Now the range on the euro yen is a pathetic 49 pips. But look, we've got the new beast over 320. And we've got, 6, 7, 8, 9, 10, 11 pairs with ranges over 100 pips. Now, you might wonder why I don't trade like the beast or the new beast. Well, part of the reason is the spread's kind of big, and I've never really traded those pairs, and I kind of like to stay with what I know. But for those of you who like the volatility, who like that extra range, maybe, let's see, we're about halfway through February. Maybe next month we could switch over to it and just see. And you can see here we had a weekly highest open, weekly H1 highest open right there. There's the monthly D1 highest open. We got close to it, but we didn't cross it. So you see here we got near it, pulled back down, started once again, came up, almost touched it, started cutting through these wicks. It didn't make a new high. Price means price is going down. And here's your daily H1 lowest open, just put in right there at the open. So price is going from green to red. We're heading down to the 125.00. Now it was funny. I was listening and watching another trader's YouTube, and he was saying something about price levels are basically bogus. They don't mean anything. Well, Michal Kreslik and I, in fact, he was the one that really did the work. But I was helping him. We were talking about it in the research that price does leave footprints, and each pair does have tendencies at certain numbers or the end. And we ran the statistics. So see, it's one thing just to talk. It's another thing to provide evidence and data to back up your claims. And, that's the difference between me and a lot of other people, where I don't just talk about a trade, I show you the statistics. And statistics is not back testing. Back testing to me, the only reason why you back test anything is to make sure your indicators work right. In other words, they trade when they're supposed to trade. But whether or not it's a valid system, I rely on statistics. So right here, we've got a pivot point that hasn't been taken out today. But if you remember, those of you who've been watching these videos for a while, and you can see the rat zone is in effect, but we took out that pivot. But remember, right here, we had a missed pivot at the 125.51 level. Well, we had a high of 125.52, so we took that pivot out. It took, 1, 2, 3 days to take it out, but it got taken out. You see, that's the statistics. That's showing you why these trades are so profitable. You see, here's all the missed pivots here. And these are the missed pivots that, in other words, these show on a certain day a pivot was missed. These show that the pivot still hasn't been hit. That's the difference between this and this, okay? So you can see here that 125.51 hadn't been hit a few days ago. Well, if you come over here, you can see that pivot, how much it missed by. So once again, it's a trading plan. We're going to fade the pivot. Now, yeah, it missed it by a bunch, and you probably would have stopped out. But when it came down here, it was time to go long on this turn trade right here. You say, okay, I know there's a missed pivot. I'm going for it. So once again, you have a plan, and you trade the plan. And that's pretty much it. So trading like a pro, you plan your money management, you plan your trade either based on a level or based on what some indicators tell you. And just remember, it's not what you trade, it's how you trade it. So go drain the banks like a pro.